Hey everyone, I'm Emily Carter, and welcome back to US Stock Stories. Today, we're diving into Microchip Technology Inc., MCHP, a company at the heart of embedded control, microcontrollers, and analog chips powering everything from cars and factories to data centers and defense systems. Let's break down what's happening inside Microchip, its latest results, products, risks, and where this stock could go next. Microchip is a diversified semiconductor company best known for its microcontrollers and analog mixed signal chips, the kind of components that quietly power the modern world. In the most recent quarter, microcontrollers accounted for nearly half of all revenue, while analog products made up around 30%, showing just how balanced their product portfolio really is. Microchip serves a wide range of industries. About 40% of sales come from industrial applications, around 17% from automotive, another 18% from computing and data centers, and roughly 10% from aerospace and defense. This kind of market diversity helps cushion the company against economic ups and downs. Still, Microchip remains sensitive to shifts in industrial and automotive demand, so when those sectors slow down, it can definitely leave a mark on the company's numbers. Revenue came in at $1.08 billion, up 10.8% sequentially, but still down 13.4% year over year. Non-GAAP EPS reached 0.27, beating market expectations. Gross margin stood at 53.6% on a GAAP basis. Management noted a gradual recovery in order rates and reaffirmed that the inventory digestion phase is finally easing. Inventory levels dropped to about $1.17 billion, equivalent to 214 days of stock, signaling normalization after a prolonged slowdown. Microchip remains committed to returning cash to shareholders. The company declared a quarterly dividend of $0.455 per share, marking its 21st consecutive annual increase. That's a forward yield of roughly 2.8% at current prices. However, total long-term debt still sits around $5.5 billion. Earlier this year, Microchip announced a $1.35 billion convertible note offering and a fab sale plan, both aimed at deleveraging the balance sheet and streamlining operations. Microchip's innovation engine is running at full speed right now. They've got several exciting things in the pipeline, starting with the PolarFire FPGA family, which focuses on low-power, real-time edge AI applications in areas like medical imaging, defense, and industrial automation. Then there's the RT PolarFire series, specially designed to withstand radiation, making it perfect for aerospace and space missions. And on top of that, the company has introduced its PCIe Gen 6 switch lineup, cutting-edge chips built on a 3-nanometer architecture, supporting up to 160 lanes and featuring post-quantum CNSA 2.0 security. These switches help connect GPUs and CPUs in high-performance computing and AI-driven data centers. Altogether, these innovations put Microchip right at the center of next-generation edge computing and AI connectivity. The semiconductor industry is still navigating the down cycle in automotive and industrial demand, especially in Europe and China. Peers like ST Microelectronics and Infineon have reported similar softness. For Microchip, this means a slower than expected rebound in shipments, though its broad end market exposure offers some cushion. Let's talk about the investment outlook for Microchip. What makes it strong and what investors should still watch out for. On the strength side, Microchip has built a complete embedded control ecosystem, bringing together microcontrollers, analog chips, and FPGAs into one platform. That combination keeps customers deeply integrated with their technology and makes it harder for them to switch to competitors. They're also tapping into fast-growing markets like edge AI and data center connectivity, which could drive the next wave of revenue growth. And finally, Microchip has a solid reputation for steady dividend increases and strong free cash flow discipline, even during industry slowdowns. Now, for the risks. The company is still highly sensitive to industrial and automotive demand, and if that recovery takes longer than expected, profits could stay under pressure. Microchip's ongoing efforts to reduce debt might cause some temporary dilution or affect margins in the short term. And although inventories are coming down, they're still higher than the company's historical average, which means it'll take a bit more time for everything to fully normalize. So overall, a strong, well-managed company with long-term potential, but one that still needs a bit of patience as the market cycle turns. Now, let's look at valuation and what investors should be watching next. Right now, Microchip's valuation shows a sense of cautious optimism. The stock offers about a 2.8% dividend yield, and there's room for upside if industrial demand continues to stabilize. Looking ahead, there are a few key things to keep an eye on. The backlog-to-bill ratio and new order trends, which tell us how strong incoming demand really is. The gross margin recovery, since improving margins are a clear sign that pricing and production efficiency are coming back. Any updates on the fab divestiture and debt reduction, both of which could strengthen the balance sheet. And of course, how quickly customers adopt the new PolarFire FPGA and PCIe Gen 6 solutions, both critical for Microchip's next growth phase. If all these pieces start moving in the right direction, 2026 could be the year Microchip returns to solid, meaningful earnings growth. Microchip Technology remains a quality semiconductor play emerging from a cyclical low. Its diversified portfolio, disciplined cash returns, and promising new products make it a steady long-term compounder, though short-term volatility could persist. If you found this breakdown helpful, don't forget to like, subscribe, and hit that bell icon so you never miss a new stock story. And if there's a stock you'd like me to analyze next, drop it in the comments. I'll make a deep dive just for you. I'm Emily Carter. Thanks for watching, and I'll see you in the next one.